Hello, everybody. Welcome to the show. My name is Stefan Boy, and this is Trading with Livevol. This is where I trade my real Reg T account, but I'm using LVX to do it. So there isn't much going on in the marketplace. Pretty much the Greeks and the EU have agreed on an extension, even though I guess there's a few more steps, so it's not completely done. Basically, Greece will have to submit, the next steps they're going to take, like the list. And once it's accepted, it will have to be approved by all the parliaments in the EU, and everyone will have to approve. So even if one doesn't approve it, then basically it goes back to the drawing boards. But I think the way the market's going, it seems like most people are thinking that it's going to get done. So on Friday we had, pretty good day in the marketplace. I don't have that much to talk about, so I'm going to cover something real quick, and then I'll kind of talk about dividends a little bit, paying stocks. So I have basically I'm long American Airlines and I'm short Exxon. So I have 20 calls. Let me actually show you guys. I have 20 calls of the March 49 calls, and in XOM I have 20 of the March 90 puts. And I'm doing that just because I feel like oil is gonna start heading back down. Let me actually type that in. I'm gonna type in the oil price right here. So I think it's gonna go back down here. I think XOM is gonna start going down, and American Airlines is gonna start going back up. As for the SPX, basically it looks like it's one of these like slow grind ups that we had most of last year, where the market just doesn't move that much and it's grinding up. And since there's not that much new news, until there's some other catalyst to move this market up or down, I think basically it's gonna stay at the same trend. And I think Greece, maybe the conflict in Ukraine might be some of the catalysts, maybe some terrorist kind of news, or or even the Fed saying something that might spook the market, or maybe they might say something very dovish that will make the markets really rally. But so far, basically, the market's just on a standby mode, but generally that standby mode is pushing the market higher. So one of the things I want to talk to you guys about, I have savings like a lot of you guys probably, and it sits in the bank, and basically you're making no interest. So one of the things, I know a lot of the investors out there aren't kind of thinking of just investing, but older folks like my parents who are kind of like retired or semi-retired, they don't want to gamble per se, but they would like to make more than 0%. And I think one of the best ways is to do it with dividends. So one of the things I did, so basically the way I got this was I typed in highest paying dividend, Dow stocks, and then this thing comes out at dividend.com. I click on it, and basically I go down the yield, right? And look at which one has the highest yield. Now, some companies, just because I know them, I'm going to be biased, doesn't mean it's right, but that's just the way I feel, right? So for example, XOM, I'm not going to be too bullish just because oil, I'm bearish on oil, so why would I buy XOM, right? But these other stocks, maybe McDonald's, even though McDonald's has their own set of problems, AT&T and Verizon, you can see that they're very high yielding, and what this means is if you put $100 into purchasing AT&T, you'll get 5.52% in yield on that money. No matter where the stock goes, currently, unless they change the annual dividend, you're gonna yield 5%, and most likely as they increase the dividend, it'll go higher, right? So the AT&T and Verizon are my favorite. Most likely, you should probably just do only one of these because they're both in the same sector in telecommunication. But let's just say you're looking at those, right? So you look at AT&T, and what you want to do is you want to look at longer term, right? So it's done okay, but it's pretty much hasn't moved since 2000. So if you started investing in 2000, you're pretty much still the same. Let's look at Verizon. It's gone higher, but it has stagnated for the last 2-3 years. So I like this kind of stock because number one, they're in the Dow, so most likely they're relatively safe. If you compare them versus other stocks, also they pay a very high yield because they are cash generating companies, right? So they make cash every month, not month after month, year after year, and they have plenty of cash to give the stockholders back. And the reason their dividend is so high is because they've been essentially increasing their dividends, and the stock price really hasn't gone anywhere for a while, right? So look at Verizon, AT&T, and you can see that they have pretty much been flat, right? So what does that mean? Okay, so now let's look at AT&T. That yields you essentially 5% for holding it, right? So let's say you had some money and you're not looking to get in and out of AT&T, right? It's not like GoPro, it's not even like Alibaba or anything of such where you're thinking of like trading, and this is more of an investment vehicle. So what I mean by investment, I'm talking about where you would tie up your cash for a year or longer, but you would know exactly what your returns will be for that year in terms of dividends and by selling options, and not so much by the stock price going up and down. So AT&T still, you can lose like 10% of the stock value, but all that means is your dividend will be higher in terms of percentage. If you invested $33.81, you will still maintain the 5.5% of dividend in terms of your original investment, no matter what happened, right? So let's say I'm not going to look at like Marches or, if you saw my other trades, it's like March 20, right? But this one I'm going to look for January. So if you look at January, you see all these trades. The great thing about these is you just click on it, you see what price they're trading. So if you're putting out an offer, you can kind of work it, right? So the last trade was 105. If you click on it, you trade at 105. Trade at 105 with the stock trading 33.78, 33.79. So the stock's trading a little higher, and basically, so you have a pretty good chance of getting this off at 104, 105. So you don't have to hit the 102 because people have been paying 105 while the stock price was here or a little bit lower, right? So that's why like this order flow page is so important because you can kind of see what your prices are. There's no need to give up 2 or 3 cents unnecessarily. Now, it's not going to make pretty much any difference on this one trade, but over the course of your lifetime, and as you get more money and you start doing a lot of trades, every penny makes a huge difference, right? So let's say you want to sell these, right? The 35 calls that expire January 16th of next year, right? So, January 15th of next year. So by selling the 35 call, you're going to make, let's say, 104, right? If you sell it in the fair value, let's say, right? So you're going to make 104. Let me see if I can. You're gonna make 104, and then you're gonna buy stock for 33.82, right? Plus, you're gonna get interest of let's see how much it is. $1.88. So you're gonna make $1.88 in interest, not interest, in dividend. And by selling these calls, you're gonna actually collect $1.04 over the course of next 9 months, right? So basically, 1.88 plus 1.04, which is what you're selling the calls for, you're gonna make $2.92. So if you divide that by what the current stock price is, 33.81, right? You're gonna yield 8.6%. Right? So basically, whether AT&T goes up, down, stays the same, you're pretty much going to collect 8.6% return on your cash, right? For 9 months, which is pretty awesome, right? So it's almost end of February. So in 10 months, 11, yeah. So in about 11 months, you're going to collect 8.6%. Which is fantastic. Now, you guys might be saying, well, Stefan, if it's so easy, why wouldn't everyone do this? What's the risk? Well, the risk is the stock actually going down and you needing the money. So you have to sell the stock for less. So let's say you collected $2.92, but essentially if the stock price fell down by more than $2.92, your net is a negative, right? If you, at least if you keep it in the bank, your net isn't going to be negative. But so there is a risk in the stock price falling, but there might be no risk if you intended to, or little risk if you intended to hold AT&T for, let's say, more than like 2, 3, 4 years, right? For the interest. So you're going to do this every year, collect 9%, and the only real risk is AT&T somehow going bankrupt and them not being able to pay the dividend going forward. But you see how if you sold a 35 call, right, basically you make 8.6% no matter what. Now, you make 8.6% if the stock stays right here, 33.81. If the stock goes down, you still yield 8.6% in your cash. And if stocks goes up, and you see how you sold a 35 call, you will make money from 33.82 up to 35, and then you'll be capped out because you basically sold a call, which meant you gave somebody the right to buy stock at 35 bucks. So if it's trading higher than 35 bucks on January expiration, people are going to pretty much exercise, and you're going to have to sell the stock for 35. Now, don't worry, you don't really have to sell your stock. For those of you who want to, who've had your stock for 10 years, you can replace it. But what I'm saying is, essentially, synthetically, that's what you're doing, right? And so you actually have a chance to make $1.18 more. So basically, $1.18 more. That's up to 35, and then you have plus 2.92. 2.92 plus 1.18. One of these days. So $4 divided by 33.81 is 12%. So this is the max you can make. So obviously you're gonna, as soon as you hit 12.1%, you're gonna cap out. So one of the things you can do, if you feel like there's more upside to AT&T, is you can sell the 37 calls, right, instead of the 35 calls. Or, if you had a more intimate understanding of AT&T, you can actually sell shorter term, right? So maybe April 17, you sell the 35 calls. Maybe by that time, AT&T might go up to 35, and then you'll sell the June 37 calls for like same amount and so forth, right? But that's a little trickier. You would have to keep your eye on AT&T. But this way, you basically, for most of the folks who have a job, or they're not that interested in like looking at a trading screen all day, this is a good way of basically putting in your money. So you put in $3,381 by buying 100 shares. You sell a call against it, and basically at the end of the year, or end of the 10, 11 months, you collect $292 in cash, right? That cash that you can take out, and then you can do the same thing again the following year, right? So it's fantastic. The kind of stocks that I like are basically safe stocks, right? So you don't want to do this with a stock that has a high beta. Basically what that means, a stock that's just going to whip around. You want a large market cap stock that's stable, and you need to have, it's important for those of you guys who are thinking of doing this to have intimate knowledge of the company that you're doing this on, right? So AT&T, Verizon, you guys know AT&T, Verizon, right? You guys know Procter & Gamble. You guys know McDonald's. You guys know Exxon, right? Visa, right? These are companies you're not investing in some biotech company that you have no idea on, right? So, but which one of these, that's up to you guys. I can't say which one is better than the other, except for the fact that I have my own biased opinions, right? So I like AT&T and Verizon because they're high. They basically traded sideways for like years. So they might be due for a breakout. And also maybe because they traded sideways for years, there's less of a chance of it going down as well. But essentially, I like those stocks. Maybe some of the other stocks I was talking about is McDonald's. Now they had tons of bad news, but they're still a gigantic company. And once they figure out and kind of come to the 21st century, which means they have to streamline their menu, basically have better training for their workers. Because I've been to a McDonald's recently, and basically the people who serve there are nice, but they're extremely disorganized. I would almost like say borderline incompetent in terms of like having the right training there. So I don't even blame the people. I just kind of blame the management for not training people well and just kind of letting people do whatever, right? And they kind of look a little understaffed, but that's just me. So that's McDonald's. I'm not as bullish on McDonald's just because, I went there and I didn't like it. So that's kind of like the extent of it. I think some of the other good candidates might be GM. So GM's been in the news lately because of activists. They believe that they're holding too much cash and they should give it back. But if you're GM, you can kind of see why they're reluctant to part with their cash, because they just came from bankruptcy in the last 6-7 years, right? So when you get that close to basically disappearing from the face of the earth as a company, you're gonna be a lot more conservative with your money. So I kind of like this stock just because I think there's a lot more upside. So GM might be one of those stocks where, like, you know what, I want to sell a call that's further out, right? So instead of selling like the ones I really look at is like kind of like the at the monies, you can even sell like the 45 levels for 90 cents, right? So 45 seems kind of ridiculous that it's that high, right? That you're selling that high of a strike, because 45 minus the current stock price, which is 37.62, it's 738, right? And then if you sell this for 90 cents, that's another 90, right? And what's the dividend? The dividend is $1.20. So they have $1.20 in dividend, right? So 1.2 plus 0.9. This is what you saw on the calls for. That's 2.1, right? You divide that by the current stock price, 37.61. And I'm doing the same thing I did with AT&T. If you guys have a problem, you can just kind of play this tape back slowly and kind of go over it. But you will get 5.6% of your capital that you invest in. But the kicker to this is because the strike you're selling is $7.38 away, essentially the max you can make if GM really starts going up till the rest of the year, which I think there's a good chance that it could happen, because usually once activists gets involved, it kind of like puts everyone at attention, and it kind of makes everyone work towards like making the stock price go higher. That's just been my observation. Doesn't always happen, but that's what I've seen many times. Okay, so basically what I did was while I was yapping away is I added the difference, so 45 minus 37.61 plus $1.20 in dividends plus 90 cents that you're gonna sell this call for, right? So you see this traded for 82 cents last, but the midpoint is 90, and that gives you 948. So you divide 948 by the current stock price, 37.61, and boom, you get 25% return max. So you can get as much as 25%, but you can also lock in 5.6% for those of you guys who, you know, let's say you wanna gamble a little bit more. Actually, I shouldn't say gamble. People always tell me like, don't say that. But essentially, you're trading and there is risk, right? It doesn't matter how you call it. Basically, you're putting your money up, and there is risk to possibly losing it all. But there's also possibility of you getting returns. So the maximum return is 25% over the course of like 11 months, or you can make minimum 5.6% and G. So I think that's pretty good. The other stock I really like, and this might not be a cup of tea for everyone, is Philip Morris. So Philip Morris, for those of you who don't know what they do, they basically sell cigarettes, tobacco, right? So you see how the stock's pretty much been steady since 2013. Essentially, what's happening is in the Western world, you know, all of us know that basically cigarette smoking is bad and it's been declining, but all in the emerging markets, they're still selling like crazy, right? And there's no government intervention currently to prevent them from just going in there and start marketing to the young kids all over the world, and they get hooked. And once you get hooked as a child, you're basically going to smoke for the rest of your life. So stuff that happened, you know, in the early 20th century in the Western world, it's pretty much happening to the emerging markets. So and these guys are going to benefit greatly from that trend. So for example, like I think in Indonesia, like 70% of the males smoke, and their population I think is in the top 6 or something in the world, right? So so yeah, you might have some, you know, Philip Morris might be a company you might not want to invest in terms of your moral beliefs, but strictly talking in terms of pure investment, basically they pay a $4 dividend, 4.82%, and essentially you can do the same thing, right? So you take Philip Morris, you go out to like the 85 calls, you sell this for $3, and then you collect 4. That's $7 roughly, right? So I'm kind of estimating it right now. So 7 divided by 82, like let's say 83, right? So you're gonna make 8.4% of your capital, and then you still have another 210 on the upside, right? 0.1. plus, what did I say, 7 divided by 83. All right, so you can make a maximum of 11%, which is, in my opinion, far better than just keeping all your cash in a bank account. Now, I'm saying you have to keep some money in the bank account, but you don't need to keep all of them. And these are a good way to basically invest for the long term. So that's about it. You guys can basically research other stocks that's kind of up your alley. You know, maybe there is some healthcare stocks or biotech stocks that you might be interested in. I know Gilead just started paying a dividend, but essentially you do some homework, but I would only do these on stocks that you understand. So it can't be like, you know, it can't be like some kind of drug company and you don't even know who uses the drugs, why they use the drugs, and you have no intimate knowledge of like what the drug is about, right? It has to be something that you understand intimately. For example, like you use Microsoft software, right? So you know how they work. You use IBM computers and such like that. So other than that, that's about it. There wasn't that much going on in the marketplace, but I hope this helps you guys to basically not keeping everything in cash or just having to buy stocks that pay dividend. In my opinion, if you are really trying to capture a yield versus trying to capture the upside, and you are interested in investing in high dividend stocks, it makes absolute sense that you should write calls against them, because essentially it's following your parameters into creating a bigger yield. So the great thing about that scenario is, unless something crazy happens, you actually know by the end of the year how much cash is going to be returned on the money that you're investing versus not having any idea. So that's it. Hope you guys are doing well. And I will try to talk to you guys tomorrow. If not, I'll talk to you guys on Wednesday. Take care and good trading.